Good morning, good afternoon, good evening. Welcome to today's webinar brought to you by the Global Institute of Credit Professionals. Today we're going to be focused on private credit, so opportunities, skills and routes into industry. My name's John Wilton. I'm a director here at the GICP and we're joined today by Andy Miller. Andy, can you give us a bit of an intro, please?
Sure. I am an executive director at Dartmouth Partners, a global search firm focused predominantly on private capital, which includes private credit, private equity, real assets, as well as the broader financial services ecosystem. We are known for our classroom to boardroom model, which involves tracking talent from undergraduate through to senior leadership positions. Dartmouth is part of the Kernel Group, and we have two sister brands, Pure Search, who work with the same client base, covering mission critical roles such as tax, legal, treasury, and Catalyst Partners, who work with HR, talent acquisition, and reward professionals. My role at Dartmouth, I lead the credit and real assets European divisions. Prior to doing what I do now, I spent a few years partnering with private equity funds, helping them to find investment professionals and fundraising talent.
Great, thank you. So just to give us a bit of an overview of who we've got on the webinar today, what I'd like to do is just kick off with a brief poll. It's just to give us an idea of the sort of level that we've got people here on the call with us. And while we're waiting for some answers to roll in, can you just give me an idea if you're sort of thinking about institutions in terms of typical buckets that you might recruit into? Can you give us some background about what those might look like?
Yeah, sure. So unsurprisingly, the majority of our work is with direct lenders, as that makes up just over half of the private credit landscape. And then the other buckets are opportunistic credit investors and special situations funds, hybrid capital or capital solutions funds, and then where we're seeing increasing amounts of activity is capital markets roles in both private equity and infrastructure funds.
It looks like we've got a good few answers here, so I'm going to share the results. We've got 14% of the population on here who are undergraduate slash graduate students, 62% vast majority analyst associate, 22% VP director, and 2% MD slash C-suite. So hopefully we can use that to tailor what we're talking about a little bit today. If we just kick things off, can we get a bit of background from you in terms of where you're seeing major sort of demand coming from at the moment?
Yeah, sure. So I think the way private capital hiring generally skews is junior, and that's the same across credit, private equity, infrastructure, real estate. We have seen year on year an increased demand for classes of associates, especially with the large US funds that are dominating more and more of the market at the moment and are responsible for more of the capital being raised. So every year there is a need for the next generation of associates and analysts coming through. And actually that is moving even more junior at the moment. So an increased number of private credit and private capital funds are engaging with early careers talent. Our early careers business have seen a real spike there. And that's largely to tackle items such as diversity, which I think we might talk about a bit later. At the more senior levels, there is more of a demand for portfolio hires. So a lot of firms in Europe are looking to build out the portfolio function, both on the monitoring side and the workout or the restructuring side. As I think watch lists are getting bigger. Firms are recognizing there's a real value in having restructuring capability in-house. These teams are relatively small or underdeveloped in Europe, and in the US it's a slightly different story. They're a bit further ahead. And on the monitoring side, just understanding the amount of data that's coming through and ensuring that the investment team are making sensible decisions. On the more senior level, there are three main scenarios where we see senior hiring take place, where a new strategy is being launched or a new credit fund is being launched, and we see a lot of private equity and asset managers launching new credit teams, either organically or inorganically, a new office opening. So US firm opening an office in London or vice versa.
Yeah.
And third and least common at the moment, where a fundraise has taken place and the vehicle is meaningfully bigger than the predecessor, and that's all happened fairly quickly. So the team don't have enough senior talent to deploy the capital that they have.
Yeah. If we take a step back from those trends then, and probably this is going to be really relevant for the sort of associates analysts on the call. What are the common feeders that we see typically tapped up by those funds when they're looking to bring in those sort of junior to mid-level hires?
Where do the funds find the talent from?
Yeah.
The most common place is still investment banking,
Yeah.
leverage finance teams. Of course, these teams aren't enormous, and probably the key criticism I consistently hear from all of our clients is that the juniors in the team aren't thinking as critically anymore, and so they will tend to look in other places. I mean, the distressed investors will often look at the restructuring teams or workout teams. We are seeing more and more appetite for hiring laterally, i.e., a large cap fund taking someone out of a mid-market if they know the credit investment space, and they're able to offer them a sizable uplift on comp or brand or global opportunity. And then we're seeing more appetite for hiring M&A bankers now, which is surprising because 3-4 years ago, if you called 10 M&A bankers and asked them if they were interested in rolling private credit, all 10 would have said no. But now with the increased profile of credit, I think there's a bit more interest in engaging with that conversation. And one of the key sells is you'll do more deals, or there's a bit more reliability on deal volume. Whereas private equity, which was always the mecca for most bankers, has really struggled for deal volume over the last few years. So it's a real range, but the predominant feeder is still the leverage finance teams.
Yeah. Just a quick follow-up to that. If you're looking at the lateral hires from maybe a smaller fund into one of the mega funds, is there a meaningful difference in the makeup of the role, the sort of day-to-day of what those hires are going to be doing when they move from one to the other?
I mean, I guess you could argue they'll be in a bigger team, and they'll therefore be more siloed. So if you were going to argue the case for the mid-market fund, then you'd say, okay, you're not going to be doing as much, you're not going to be as exposed, there's more layers between you and the senior leadership of the business. But ultimately the role is still largely the same. So I don't think there's a huge difference. The driver tends to be the comp is one of the reasons. You can get a 25 to 35% uplift at associate and analyst level, moving from a mid-market to a large cap. Otherwise, it may be what they perceive to be an upgrade in brand, or giving themselves more optionality down the line by having more of a global name on their CV.
So if we look at the sort of typical skills that you need to focus on when you're searching for a candidate, and therefore that these funds are searching for, are there any themes in terms of the technical skills that people look for, possibly also the soft skills?
I mean, technical skills are a must. There's regardless of the size of fund, the strategy, there's always a minimum bar with technical skills. And when you go through an interview process, doing a case study, often actually a case study and a modeling test isn't necessarily an opportunity for someone to demonstrate how incredible they are at all these things. It's to make sure that the numbers aren't upside down, and they can do the job, and then they'll be judged on the other aspects of their skill set and their strengths. So technicals are a non-negotiable. Soft skills are increasingly important, and actually it's interesting to see what happens with the development of AI, and I think that will probably be even more prevalent over the coming years. And on top of that, it's the ability to think commercially or critically. So again, a common piece of feedback we get from a lot of clients is from a junior candidate, is after a case study, they weren't necessarily able to think outside the box. They were very comfortable in their comfort zone and they were able to process information and complete tasks as needed. But if you tweak information and change it or change something about the environment, then suddenly they became very uncomfortable and weren't necessarily able to deal with that. And I think that comes from just really thinking critically about your job day to day. A lot of people turn up and they'll process the information or they'll complete their task for their boss or their VP, and that will be that. But the best people are the ones that ask questions. You know, they ask why it's happening, and what the working is behind that. They're always the people that perform the best.
Yeah. You sort of touched on this very briefly. If we take a look at the interview process itself, is there a common format that most funds will follow when they're hiring? And if we sort of drill down on that as well, are there any major differences between maybe a small mid-cap fund and mega funds in terms of their typical process?
So processes tend to run a fairly standard format, which is first meeting, a CV discussion, get an idea of what that person's done, how they've done it, their motivations for being in the room. The interviewer will usually make a soft assessment of the personality type and how they articulate their points. The middle interviews, so that can either be a further interview with a technical grilling, a real deal, run through, and or a case study. But a case study will always come in at that middle point, and it usually follows a fairly a standard format.
Right.
You might build a simple LBO or a cash flow lending model. You'll have an IM that you'll need to pull together, and you might present it to a pretend investment committee and say, this is what I think about this investment. And to my point earlier, the modeling aspect is usually just to make sure the numbers aren't totally upside down. The commercial aspect is a little bit more subjective. Once you're through the case study, you're normally in a pretty good spot. And so the further interviews off the back of that will be culture fit. And this is perhaps the key difference between the larger funds and the smaller funds. I think larger funds will perhaps be a bit more systematic around that and just make sure they've ticked off all the right people. The smaller funds may actually spend a bit more time with that person and make sure, can I work with them? It's an office of 10, 15, 20 people. Let's take them for a beer, a coffee, lunch or something. And so that can sometimes take a little bit longer. I'd say the key difference is normally the difficulty of the case study or the complexity of the case study, let's put it that way. And perhaps the number of rounds. In the bigger teams and for the bigger funds, you might need to see quite a few more people, and they'll constantly be reassessing your technical capabilities because frankly, for the larger funds, technical skills are usually more important.
Right.
And I mean, senior search is run in a very similar way. Substitute a case study, albeit you may still have to do one for maybe a deal sheet run through, and discussion of your track record to ensure you've done what you've said you've done on paper. But otherwise, it's very much the same format.
If we try to sort of look forwards into various skill sets that you think might be valuable to focus on for the next few years. I mean, you've mentioned AI, you've mentioned maybe a bit of a sort of focus on soft skills, which I think is particularly important from our side. We've seen, Gen Z, we need to sort of make sure that we foster the right environment for them to be able to flourish as well. What are the key skills that you think are worth focusing on from a candidate perspective?
It's difficult to necessarily guarantee you'll be able to do this, but like really deal experience trumps everything at the moment. Having been in the market for over 10 years, seen not every cycle, but a few cycles, and the difference between a boom and someone having X number of deals in their CV after 2 years of being an analyst or an associate versus being in a career for 3 years and having not done a deal, then that's it's quite a big difference. And actually, those people do tend to struggle when looking around, or they're asked a few more questions. So one of the primary points I would advise people in the audience, predominantly junior, make sure that you're joining a shop that will give you a learning opportunity. There is deal flow there. There are people that will invest in you, and you'll pick up the skills that you need. But outside of the points we discussed earlier, just being intellectually curious and rather than just processing the information, really that's what sets associates, VPs, and analysts above the rest of their class.
Yeah. Maybe continuing with the point about setting people above, making them stand out. All other things being equal, how can somebody stand out or make their CV stand out, for instance, when they're considering move to private credit? So, we've got the obvious ones of working for a big name, having a Goldman Sachs, JPM on your CV. What else can people be doing to make sure that they do get the chance to show what they can do at interview stage?
Yeah, it's a tough one at the moment. Feedback from a lot of clients is they see a lot of really good CVs, and the bar has gone up every year. In private capital, especially, there is it's harder and harder to get past the mark. I think you've touched on it there, the experience point. So there's no substitute for the biggest names on CVs anymore. And ultimately, when you look at private capital, you've still got roughly a third of associates coming from the big US banks, which shows you the skew and the influence that those businesses still have. That's one point. The internship experience is really valuable now. And we are seeing increased awareness of this, especially with a lot of initiatives engaging younger people at a younger age, before they get to university, to really explain the market and the importance of getting those type of experiences and giving them the opportunity, especially children that perhaps don't have access to that, who don't have someone at home that's talking about private credit or private equity around the dinner table. So outside of the good grades, the experience, building a network is probably one of the most valuable things. I think there'll be tons of jobs at the moment on LinkedIn that you can go away and apply to. And mentioning AI, actually, one of the interesting points is we suspect a lot of young people are using AI to maybe fill out 500 job applications. Which means, and we've seen this on our early careers team, suddenly you have 10 times the amount of applications that you did the previous year for, the same number of graduate roles. Those businesses are then using AI themselves to process those applications with this ongoing battle of technology. Where you can stand out is if you've networked with people in that business, perhaps, you've grabbed a coffee with someone, you've had a call, you've sent them a message on LinkedIn, you've just tried to understand a little bit more about what they've done. You can genuinely differentiate yourself in that way. And people are always really happy to help you out, as most of them were in that position as well. I do understand the genesis of the question and the challenge of standing out in amongst a sea of people that are all trying to do the same thing. If you can build a network, that will help you. Same with recruiters as well. You need to speak to some recruiters and build relationships.
Yeah, great. Can you give a bit of a rough guide in terms of what people should expect comp-wise? Maybe if we look at it from, analyst associate level, maybe a little bit above, and if there are any major regional differences.
Regional differences, yes. The key influence to that being cost of living, i.e., in the US, we see salaries roughly 20 to 30% higher than we do in London. In London, we see them roughly, if not slightly lower, slightly less higher than mainland Europe. But in terms of some numbers, the key difference between the mid-market and the large cap is at the junior levels, anywhere from 20, 25 to 35%. That quantum actually increases over the levels of seniority, where you see a big spike as well as the LPs, direct teams, just because they have a very different comp structure with their long-term incentive plans. You don't get carry in the same way. It's realized as an annual cash comp subject to income tax rather than capital gains tax, but nonetheless you get an outsized cash comp at the end of the year.
Yeah.
Rough numbers, base salary for an analyst nowadays should be close to 100, around sort of 70, 80K mark. Associates should really be about 100 to 120. And then in both cases, you should be in the mid-market, certainly able to earn up to 100% bonus. In the large cap, that goes far beyond 100% bonus. And the larger funds, the base salaries actually stay quite low, especially with the US players.
Yep.
But your total annualized cash comp can grow through the roof very quickly. So we've produced a comp report on this, and if anyone's interested in getting any of this data, then I'm very happy to share that with them.
Great. I should probably also clarify, actually, were we talking in sterling or dollars when you were quoting those figures?
Sorry, that's a good point. I was talking sterling.
Yeah. Okay.
Yeah.
Great. One more little focus from my side. If we're looking at sort of trends in hiring, I think perennial sort of thing that comes up is hiring for fit, but also taking into account diversity, culture of the business. Are there any sort of pushes that you see from your side, as an agency recruiter when it comes to DEI, for instance?
Yes, so this has obviously been a hot topic for a long time over the last few years. The split in private credit is not great. It's about 80% male, 20% female, and gender diversity is not the only point here, but it's the main area where most of these funds have focused on because it's visible diversity and they've been able to approach it accordingly. We are seeing more and more interest in engaging with undergraduate talent. And an increased number of private credit funds that are no longer willing to simply be dependent on what the investment banks are doing and how they're successfully or not successfully approaching their diversity or hitting their diversity targets. But the social mobility has probably been the more important subject over the last 2 or 3 years, especially. So Dartmouth has the Classroom to Boardroom Foundation, which engages with children in what we deem to be underprivileged areas. And there are all kinds of ways that we assess that. And we get senior leaders from credit, private equity, infrastructure to come and have a conversation and basically explain to those kids, this is what the job looks like. You still need to go away and work hard and get the good grades, but
it's there.
This is what you could do. Yeah, exactly. Where they don't know that previously. So the social mobility piece has probably been the most important topic recently. Of course, Mr. Trump, did try and torpedo a few DEI initiatives this year, and I think in the US especially, we saw a few searches with various private capital funds for ESG roles and diversity-focused searches, or where diversity was very important. Effectively cancelled overnight. Actually, in some cases, in Europe, it was it didn't quite happen as dramatically as that, but for some US funds with European offices, it was still notable that they seemed to engage with the conversation somewhat less.
Understood. Look, that's been really useful. I'm going to start to take a look at some of the questions that we've got rolling in. The first one that we have is, how easy is it to jump from public investment grade or high yield credit to the private side? Have you got any views on that?
Depends on your seniority. In the last 12 months, we have helped people to make that move. At even a mid-level, so I would say sort of an experienced VP, into a range of roles, including into a capital market seat at a private equity fund. It's not straightforward. The high yield market and the liquid credit market is a bit of a different beast. Obviously, it's older than private credit in itself, and I think especially with the evolution of private credit and a lot of these hybrid capital cap solution strategies, or even more vanilla direct lender, at a senior level, like the skill set just isn't as transferable. So yeah, it
Yeah.
would entirely depend on the years that person has. At a junior level, I think you can
Yeah.
argue the case that there's still a long way to go, and
Yeah.
if you understand the credit investment space.
We've got another one, which is what are your thoughts on moving from leveraged finance asset management to private credit? It seems like investment banking is the traditional background, but I'm curious about how I might move to private credit from managing high yield ETFs and leverage loans. So maybe a similar sort of,
Yeah, I get it. It will really depend on the seniority of that person. I wouldn't rule it out. You and I were having a conversation beforehand around what our clients ask of us.
yeah,
Actually, in some cases, if we meet that person and we can see that they have a lot of strengths outside of just the CV, which
yeah,
perhaps doesn't fit the cookie cutter, then we could ask the question of our client. But it's
yeah,
if a direct lender calls us and asks us for an associate in leverage finance, then that's not the profile they would expect us to
yeah,
show them.
yeah,
So there needs to be some other reasons around it. That person needs to have uh, spikes in certain areas that we can leverage.
yeah. Great. Another interesting one. Would a management consulting background such as McKinsey, Bain, BCG be a strong foundation for transitioning into private credit after an MBA or other graduate studies? And if so, what would you recommend to prepare in advance?
So potentially yes. It would likely be a route for a special situations
Yeah,
investor, uh, possibly a capital solutions or a hybrid capital investor. But there would need to be an element of uh, operational input into the assets that you're investing in.
yeah,
I don't think going into a role where you're largely you're largely structuring and you need to over-index on financial modeling, then no, management consulting is not the best route.
yeah,
But yeah, we've had searches in the last 12, 18 months where actually a management consultant has been an interesting profile. So I think you bring different strengths to the table.
yeah,
What that person needs to be aware of, and yeah, what you'll need to go away and do some extra homework on is the technical skills and the
yeah,
financial modeling,
yeah,
because as mentioned earlier, there is a minimum requirement there. So you need to be able to do it. And firms are very happy to look at different profiles, i.e., someone with a consulting background. But if you can't make the numbers add up,
yeah.
then you won't get anywhere.
Thank you. We have another one, which is, are there many operational slash data slash tech related roles in private credit? Um, and if so, uh, what is the type of route for these?
Yeah, that's an interesting question. I mean, the most operational role in credit I can come up with is working in a portfolio team
Yeah,
or in a workout team,
yeah,
as your role is entirely getting around management teams
yeah,
and assets that perhaps aren't doing what they're meant to be doing. Um, uh, the classic background for those people is folks coming from either a workout team, a restructuring team, uh, a distressed investor.
yeah,
The tech element there, I mean, that's quite a broad question. You've gone down a
yeah,
few different angles
yeah,
there.
yeah,
But I suppose you could look at it on the monitoring side of portfolio. There is a big tech component there. And Dartmouth, not too long ago, launched a tech leadership business, which has seen lots of interest from private credit and private equity funds as they're all trying to get around what they're doing in AI and how that will
yeah,
impact their ability to operate. So I'm not offering great advice to that person, but yeah, if they want to get into an operational role,
yeah,
a workout team, go do something in restructuring. If you want to do tech, then I'm not the expert, sadly.
yeah. How can somebody get an internship in private debt when they have no previous high finance experience? What skill sets are funds looking for intern roles?
That's a a tough question, actually. It's not one I could claim to be an expert on. And if that person does have more questions, they should contact
Yeah,
our early careers team. There are various bodies and initiatives that will help someone with no high finance experience or potentially, the background to that point get access to these type of internships. So you
Yep.
have 10,000 interns, Gain, SEO, Dartmouth's early careers team, classroom to boardroom. So I would recommend that person speak to a few of those bodies as
Yep.
they are the experts in helping do that.
Yeah. Great. At what level does carry typically become meaningful in private credit? I think I
Yeah,
touched on that a little bit earlier, but
yeah. Depends what meaningful is to you, but
yep.
the numbers are always yeah, pretty insane. So comp normally comes into play with your first promotion, is what we tell people. Now there are firms that may take a bit longer, and there are some outliers that may offer it on day one.
Yep.
So as a sell for other points, I would say it becomes meaningful, yeah, really at the VP level.
Mhm.
You might get a few 100,000 as your first allocation. Of course, that's going to be really meaningful to some people, but the numbers will be meaningfully larger with your next allocation at either experienced VP or maybe even your first director allocation.
Yeah. And then obviously there's the differences mentioned earlier between possibly LP comp structures and how that might come into things, right?
Exactly. Yeah. The numbers are obviously still very big with the larger funds, but your cash comp is going to be significantly bigger versus a mid-market. I think the
Yeah.
mid-market funds will usually, rightfully deliver the message that actually their carry allocation is really attractive, even if they're offering lower cash comp. And
Yeah.
the LPs have a totally different system. So
Yeah.
it's all in the report.
Another one. So how easy is it to move from an ESG role to private credit? If not easy, are there any intermediate steps that you'd advise to take? And I'm assuming that this person means impact investment when they see ESG. If not, you can contact us and we can address it.
Well, I mean, there are a few. So when people use the term ESG,
Yeah.
they could talk an impact investor, and maybe they're in an investment seat as part of a sustainable investment platform, or
Yep.
actually maybe you're in an ESG reporting role, which usually
Yep.
sits somewhere between the investment team and the investor relations team. So yeah, really, it depends on what that person means. If they're in an investment seat, then they're well placed to move into a role in private credit because it
Yep.
sounds like they'll have the right skills. If they're in a seat between IR and the investment team, or even more of a pure reporting role, then they need some transaction experience. That's really the key.
Yep.
Depending on the firm they're in, maybe they can get some kind of internal move. And if you've got a bit more of a reputation and credibility there, but it's hard. ESG is a very broad term, so it's hard to say without
Yep.
knowing a bit more about that person's skills.
Yeah. One more and then we're still getting them coming in actually. So I'm currently in an entry level position looking to get into opportunistic slash special sits.
Mhm.
Are there any skills or experience that I should focus on to move it into that arena?
And where are they now? Sorry.
So currently we don't have background on where they are. It's
Okay.
just an entry level position, and they're looking to get into opportunistic or special sits private credit.
Okay. My advice to that person without knowing what they're doing
Yeah.
is just throw yourself into as much as possible. Get as much experience in as short a period of time as you possibly can. That will make you stand out.
Yeah.
I actually think that in the European market, it's slightly different in the US. Experience trumps education all
Mhm.
day long. If you're in a good firm, or you've done a lot after a couple of years, you'll be looked on more favorably than someone that's perhaps spent longer in education or done
Yeah.
an MBA and got some less relevant deal experience or working experience. In the US, it's a different model,
Yeah.
as I think MBAs are regarded and are held in higher esteem
Yeah.
versus the European market.
Yeah. Okay, great. We'll leave it there for the questions. We do have a few more, but I think they're going to be best directly answered. So if people have got any that are outstanding, we will get back to you. Couple of reminders just before we go. So firstly, if you are looking just to get a bit more information about where careers might lead you, the GICP does have our guide to careers in credit. If you head to gicp.org, you can download that, and it's looking at a wider universe than just private credit. So hopefully you can get something of value from that. One other thing is that you should hopefully see a QR code. That is for our information session on the Global Credit Certificate, which we're running on the 19th of November. It's a really good way to build out a demonstrable skill set in credit. So if you're looking to advance your career and you want to be able to prove your skills, it's an excellent way to do that. So if you're interested, I would highly recommend joining us for that. Otherwise, thank you very much for joining us today, and hopefully we'll see you on the next one.